Hello friends, welcome to the course on Accounting and Financial Management for Bankers. In this session, we will learn about the maintenance of cash, subsidiary books and the ledger. Let's start with the introduction part. All recognized businesses concern use of the double entry system of bookkeeping to maintain their accounts. So we all aware, right? What we are following? Currently, we are following the double entry system of bookkeeping. What is bookkeeping? Means simply recording of the transaction. Means to record the transaction, we are using the double entry system. Bookkeeping is the process of recording of your company's financial transaction into the organized accounts on daily basis. What is bookkeeping? Simply we learned in the previous session. Bookkeeping means simply recording of the transaction. Recording of the business transaction is called as bookkeeping. The double entry system recognizes the fact that every business transaction has a two aspect. Double entry means what? For every transaction we are having two aspect, right? Thus, under this system, one account is debited and another account is credited for every transaction. What do you mean by double entry? Double entry means simply for every transaction, there is one debit and there is one credit, right? That is called as the double entry system. So, in this lesson, we shall learn how to use the double entry system to record the transaction in the book of account. For example, like a journal, ledger, cash book, or the petty cash book. So, this is the area of learning. Now see, what do you mean by the journal? See, journal is the book of primary entry. First remember, what is journal? Journal is the book of primary entry in which every transaction is recorded before being posted into the ledger. So basically we are having two type of books here. One is the journal, another is the ledger. So when we do the entry, first it goes to the journal. Then it is being posted from journal to the ledger. Okay, so we can say that the a journal is the book of a primary entry. So in a journal, transactions are recorded in chronological order. What do you mean by chronological? Means simply one by one, right? So means first, then second, then third. So they will maintain the chronology. It is called as the by order, showing the debit and credit of the account as affected by the transaction, right? So every transaction has a two aspect, debit and credit. They are recorded into the chronological manner. For example, cash I have taken, if I am the cashier, I have taken the cash at 10 a.m., right, for 50,000. I will do entry, right? The next cash I have taken at 10:30, right, 60,000. So when you check the transaction into the book of journal, you will see as per the time. That is what is the chronological order. The book of a journal contain the column LF. What is LF? LF stands for the ledger folio. This record the page number in ledger where the accounts in the particular column are transferred or the posted. So what do you mean by ledger? Ledger means simply, see, you have done the entry. For example, here is a date, here is particular, for example, from cash to cash, right? Ledger. So this entry where you are going to post that ledger page number is given into the ledger folio, right? Ledger folio is nothing but the page number where where the entry has been posted. Okay, now one thing, journal also contain the narrative description of the transaction. So when we take the cash, right, we write in the narration, right, either self or party's name. So in the same way, journal also have the narrative description. Journal record each transaction, right? Very, very important, because see, whatever entry done in a simple way, whatever entry done by the clerical staff, it is called as the journal entry, right? Once that entry is being posted, that will become the ledger entry, right? It may happen that some entry officer may pass, some may not. For example, officer has denied to pass the entry where if the account number is not matching, so that entry only remain into the general, that will not move to the ledger. Okay, so very simple thing. Okay, so this is the format of a journal. See, there is a date, there is a particular, there is a LF means ledger folio. It is simply the page number where the entry is being supposed to post. Debit amount means how much amount should be debited and what is the amount to credit. Okay, so example you see here practically. See, here is date given, right? Here is account title. For example, see here on 3rd of January, there is transaction for in the purchase of transaction in the cash. So which account you will debit and which account you will credit, right? So that we are going to discuss in detail about the passing of entry. You just understand the format of a journal. Okay, so what is first? Only one thing you remember from this slide, you remember that journal is a primary source of entry, or simply it is the primary entry. From journal, it is work done at an entry level, like a clerical work, right? If we pass that entry, that will move to the ledger. It is called the posting, right? So these are the two different things. Okay, only one thing remember: journal is the primary book of primary. Journal is the book of primary entry. Okay, it contains the transaction in chronological order, means by one. Okay. Now, what are the steps to pass the journal entry? See, these steps you don't need to mug up, don't need to remember, okay? Because when we learn how to pass the entry, that time you will automatically have to go through that steps, okay? Just go through it. Step 1 is simply record the transaction and find out what are the two accounts involved. For example, there must be the two accounts. One is debit, one is credit. Okay. Step 2, we have to find the category, right? Whether it is account, personal account, real account, or nominal account. That we will see in detail. Okay. No need to worry. Step 3, we have to apply the golden rule. Which account must be debited, which account to be credited. And next step, we have to enter the date of transaction. We have to enter the particulars as a narration. And next, we will enter the amount in figure, right? Okay, that means simply whenever you doing entry into the bank, in the same way you have to follow it. Okay, no need to worry about the steps, no need to remember. When we learn how to do the entry, automatically you have to follow that steps. Okay, very simple. You will first find which accounts are involved, right? We will find the which accounts are involved, right? Then we will find account type, and based on that we will apply the golden rule. We will decide which account to debit and which account to credit, right? And we also write the date and particular while doing the entry, and then we will write the amount. Okay, so these are the basic steps which we have to follow. Okay, no need to mug up. Okay, now see, there is one book called as the cash book. What do you mean by cash book? A cash book record all the cash transaction. See, name is indicating cash book. It is a cash book. What is a cash book? Simply where all the cash transaction only are supposed to be recorded. Okay, for example, it is like the ledger of a cashier's books, like that. Okay, it is having cash receipt and the cash payment. That's why we can say it is a cash book. A cash book is in the form of account and serves the purpose of a cash account. It is like a cash account. Okay, it will serve the purpose of cash account. Very simple. See, name it is indicating cash book means it record all the cash transaction only. It has two sides, debit and the credit. The debit side record cash receipt and the credit side record cash payment. So it is just a reverse of passbook. See what if you have worked as a cashier, you might notice there is one account called the teller account. Okay, the cash account or the cash on hand account in the bank. It is with respect to the cashier. Okay, this is the cashier's account. Okay, say. So in that account, you can notice whenever you do the payment, these are credited. Payments are credited. And whenever you make the receipt, these are debited. Right? You just notice it when you go to the bank, right? So what I have told, all cash receipts or a credit side and cash payment, cash receipts and cash payments are there. Debit side is the cash receipt. So cash receipt at the debit side and payments at the credit side. So you can say cash book is like your teller account transaction, your cash account transaction, or cash on hand account transaction. Okay, very simple. Now the cash book is regarded as the book of original entry, since all the cash transactions are first recorded in it. So we can also say that cash book is the book of original entry because it is recorded first time in the cash book. Thereafter, the posting to the respective ledger account are made from it. Items on the debit side from the cash book are posted on the credit side of the ledger, and items on the credit side of the cash book are posted on the debit side of the ledger. It is very, very important. See, there must be the debit and credit equivalent, right? So whatever debit into the cashier account, the cash on hand account, or the teller account you are seeing into the bank, that must be the credit into the passbook, right? So what is a passbook? Passbook is like a ledger, right? So whenever there is a debit into the cash book, there will be the same entry supposed to reflect as the credit into the ledger, right? For example, I tell you, if you deposit 50,000 rupees in your account going into the bank, so 50,000 rupees is credited in your account. Say my name is ABC, right? In the same way, automatically 50,000 will be debited to the teller's account, the cash on hand account or the cash account, right? So we can say whenever there is a debit into the cash book that must reflect as a credit into the ledger. Okay, the cash book is also called as the ledger or the book of final entry, since it record all the cash received and the payment. So it is very important to note that we can say cash book as the book of original entry also and as the book of final entry also. Thus the cash book is both subsidiary book and the ledger account. So it is very important to note that how we can say the cash book can be the original entry, because first time transactions are recorded. The same transaction is being posted into the ledger. So we can say it is the book of final entry. So we can say it is a subsidiary book also and the ledger account also. Right. So these are the important bits. Simply, what is a cash book? It is also called as the book of original entry. It is also called as the book of final entry. It is also called as the subsidiary book or the ledger account. Okay. Now, stages in accounting cycle. So we learned in the previously, right? What are the stages in accounting? We know we are having recording, classifying and summarizing. These are the stages. So what do you mean by recording? Means simply the transaction should be recorded into the journal or the subsidiary book. When that takes place, it is simply the recording of the transaction, bookkeeping. Next is the classification. So all entry which we are doing into either journal or the subsidiary book, that must be posted in the particular ledger account to find out the effect of all transaction in particular account. So we will classify the transaction, right? So based on that classification, we will post that transaction. For example, we have different entries we have done, right? So once we post that entry, that will move to the ledger account, right? It is called simply the classification. Then in the summarizing, the last stage is to prepare the trial balance and the final accounts. So what we prepare? We generally prepare the profit loss statement and financials, right? So for a particular period, we prepare it. So it is a process of summarizing. Okay, that all we have learned in the previously. So what order we have to follow in the accounts? First we prepare the journal, then we move the entry from journal to the ledger. Then after that we prepare the trial balance and then we prepare the final accounts. Okay, so first we prepare the journal, then we will move that entry to the ledger. We prepare the trial balance and finally the final accounts. Okay, so these are the steps why we are preparing into the accounts. Okay, now just compare here the journal and the ledger. So journal, very simple, the transactions are recorded first into the journal and then in ledger. After the journal entries are journal entry, they are posted into the ledger. So first transaction come into journal, then after posting it becomes a part of ledger. Okay, very simple. This is the book of first original entry and this is the book of secondary entry. Because why? Because transactions are recorded first in journal, then in ledger. It is a book of a chronological order. Means what? By sequence, one by one, it will record the transaction one after another. It is a book of analytical record. It is not a chronological, it is analytical record. Okay. It is a more reliable as entries are passed first year. However, ledger is the place where entries are made after recording in journal. So process of recording the transaction in the journal is called as the journalizing, and the process of recording transaction into the ledger is called as the posting. Okay, so these are the basic differences. What you should remember, simple thing, journal is the first entry, ledger is the secondary entry. Okay, so it is called as the original entry and ledger called as the secondary entry. It is a chronological, journal is chronological, whereas the ledger is analytical. Journalizing means the process of doing transaction in journal and the process of recording transaction in ledger is posting. Okay, that one difference you should remember. Okay, so they in the exam definitely they will ask the process of recording transaction in a journal is called as the journalizing, posting. Okay, like that. Okay, so they will make you confused, so don't worry, right? Process of recording transaction into the ledger is called as the posting. So who does the job of posting in a bank? So officer does the job of posting, right? Assistant manager, officers. So they are doing the ledger entry, right? And who does the job of journalizing? Generally the clerks are doing the job of journalizing. In that way also you compare and remember. Okay. Now posting entry. So how, see, the process of transferring debit and credit item from a journal to the respective account is called as the posting. Means what? Transferring entry simply from a journal to the ledger is called as the posting. It is done by the officers, right? So while posting, the word to is used with the account shown in debit side and by is used for the account shown in credit side, which we are following, right? When we debit account, customer's account, we write, for example, for cash payment, customer reaches, what we write? To, for to ABC, to Santosh, to, right, to Ashwini. That means what? We are writing what? To means what? When we are debiting the account. And if a person deposit the cash, we write by, self, by the person's name means what? When debiting, we are using to word in the cash also, right? And while crediting, we use the word by. So while posting, if a general account is debited, the ledger account should be debited. Okay. Now see, the balancing. What is balancing? If the account means, see, it is very basic thing. When we do the posting, for example, it is not like that clerk has entered the cash receipt, and while posting, the officer make it the cash payment. Whether it is possible, it is not possible. So what I can say, if a general account is debited, the ledger account should be debited. Means what? The same entry which clerk has been done has to be passed by the officer, right? He cannot change cash receipt to the cash payment like that. Okay. Balancing. Balancing of account means simply the process of equalizing the two sides of an account by putting the difference on the side where amount is short. See, balancing means what? See, balancing, right? We have to do the balance. Whenever there is short, we will put some weight here. It is simply, it will be balanced, right? So when the debit side of an account exceeds the credit side, the difference is put on a credit side. Obviously, when debit side is more than the credit side, then we will put a difference on a credit side. So we will put difference on the credit side. The account is said to be have a debit balance, right? So obviously, whenever account is in a deficit, we can say debit balance. When account is in excess credit, we can say it is a credit balance. Okay, very simple. No need to worry about it balancing. Now, one important thing we will start here, the different category of account, classification of account. So basically, we are classifying the account into two classes, right? One account is the personal account and second is the impersonal. What do you mean by impersonal? Means non-person, right? Name it is indicating person's account, non-person account. So further, the impersonal account we classify into the real account and the nominal account. Okay, so just go through the chart available. See, accounts we classify broadly into the personal account and impersonal account, right? So further, personal account we classify into the natural person, artificial person and the representative person, right? Impersonal account we classify into the real account and nominal account. Further, real account we can classify into the tangible and intangible. Okay, I will explain again. No need to worry, right? Just note it here. Accounts we broadly classify personal, non-personal. Personal, it may be the natural, artificial or a representative personal. Impersonal, it can be the real or the nominal. Real, it can be tangible or non-tangible, right? So these are the type of account. However, you only, if you remember, there are broadly three type of account. One is the personal account, second is the real account and third is the nominal account. Personal account, real account and nominal. So these are the three important type only you should remember. If you forgot remaining, no need to worry, right? But at least remember, if broadly, if in the exam also, they will not ask you in detail. They will only ask you what are the type of accounts. Simply the personal account, real account and nominal. At least three you should remember, must remember. Okay. Now see, personal account. So personal accounts we know we have classified into the three category: the natural, artificial and the representative personal account. Natural person means simply see, natural personal account also called as the God's account, because we think that these are the creation of God. For example, the natural person like individual, for example, the proprietor of the business, the partner of the business, the customer, supplier. So these are the human beings, right? So these are the human being. These are the creation of the God. It is also called as the God's account. So this is the natural person account. For example, the account, say the account of Suman in Indian Bank, it is called as the natural person account. Okay. Artificial person account. So artificial persons are the creation of law, like a company, the firm, the trust, club and bank. So these are created by the law, right? So natural persons are the creation of a God. Natural person account are the creation of the law. For example, if I am having the account of, say, the Kerala Samaj Trust, okay, so this is the account of what? Artificial person. If I am having the account of, say, the ABC Enterprises, so this is the artificial person account. Next is the representative personal account. What is a representative? So representative personal accounts are those account collectively account of individual whose individual accounts are neither opened or suppose not required to open. I repeat, see, representative personal account are those collective accounts of individual whose individual accounts are either opened or not required to open. So collectively they are representing the person simply. For example, see, salary outstanding account, rent outstanding account means what? So these are the account where salaries are accumulated and we have to distribute to the employees, right? So salary outstanding account, rent outstanding account, so rent which we have to pay. Okay, so these are the account which represent the person, right? So simply the account of individual whose individual accounts are either to be open or not, these are the representative personal account. Okay, so when we learn about the more example, you will get better idea. Okay, so just simply natural person means simply like a Suman, Sumit, right? Artificial person like a ABC Enterprises, representative account like a outstanding account, right? Next is the impersonal account. So what is impersonal? Simply non-personal. We categorize further it into the real account and the nominal account. Real account means simply those are that account which are related to the property or asset. Real means what? Simply you are having the asset. It is called as the real account. Account of asset is the real account. Further, we classify real account into the tangible and intangible. Tangible means which you can touch and feel. For example, land, building, furniture, cash. These are very, very important. The cash is the real account. It is very, very important. Cash is the real account. You have to remember. Okay, very, very important. Because most of the transactions are done in cash. So the asset account are the real account. Tangible means which you can touch. Intangible which you cannot touch, but these are the asset. For example, the trademark, the patent, the goodwill, these are the asset, the software, right? So these are the asset, but you cannot touch and feel. That's why it is intangible real accounts. Now, nominal account. So these are opened in the book to explain the nature of transaction. For example, these are with respect to the expenses, the losses, the income and the gain incurred into the business. For example, the salary account, expense, rent account payable, wages payable, commission received, commission payable. So these are the nominal account. Very, very important. See, real account are specifically with respect to the asset, and the nominal account, these are mainly with respect to what? The expenses or the losses or income or the gain. Okay, very, very important. Okay, now see, in addition to those type of account, there is one account called the valuation account. These are being recognized. For example, provision for a depreciation of account, provision for the doubtful debt account, right? So these are what? These are the simply valuation account. Okay, no need to worry about valuation account, just additional type of valuation account. So if there is any depreciation, from where you will do that provision? From valuation account. Okay, or the provision for the NPA category. Okay, bank has to do some provision, right, from its profit for the NPA accounts. So that can be done from the account called the provision account. Okay, so these are the valuation accounts. Now in short, see, we learn these are basically three type of account: the personal, real and nominal. Personal account we classify into the natural, artificial and representative. Real account we can have the tangible and intangible, and nominal we are having the income gain account or expense loss account. Okay, just note here through pictorial representation you will get better idea. Personal account, person, right? The real account, asset, furniture, asset, AC, real account. Nominal account, wages paid, wages, right? Income, expense, these are the nominal accounts. So in that way you have to remember. Okay, now through example you will get a better idea. Personal account means what? Simply the bank, artificial person, the Tata Steel company, artificial person, Santosh, individual, personal account. The capital account of Rajesh, who is the owner of that firm, that the asset capital, right? So very, very important to note exam point of view that capital is also the personal account. Bank loan, artificial person, name in the firm ABC Enterprises. Bank loan is the personal account. Rent outstanding payable, it is also the representative personal account. Okay, so these are the example of personal account. Now real account. So real account means simply the assets, right? The plant and machinery account, investment, land, building, the stock in hand, the cash, very, very important, the trademark, bill receivable. These are the real account example. Nominal account means simply expenses or the income. So the interest payable, the salary, the rent, the carriage, these are simply the carriage charges, the commission received. These are the type of expenses. The insurance premium, the discount received, paid, wages. So these are the income or the expenses, right? These are the nominal accounts. Now, concept of a debit or credit, also called the golden rule of a debit and credit. This is the very, very important for exam point of view, right? Throughout accounting, you have to remember this chart. Otherwise, you will not able to do the journal entry. Okay, so what are the golden rule of a debit and credit? See, every transaction have two legs. One is debit and the other is credit. So the difference between the total debit and total credit is the account balance. Okay, just to go through the rules. What are the rules? See, we have three basic type of accounts: the personal, real and nominal, right? What to debit and what to credit is important. In case of a personal account, we have to debit the receiver and credit the giver. In case of personal account, we have to debit the receiver and credit the giver. For example, the person is depositing a cash in the Suman account. In Suman, there is the Suman, right? Miss Suman has account in Indian Bank, and Suman want to deposit the cash in his account. So what we will do? We will credit the giver. Miss Suman is giving the cash to credit in her account, so we will credit the Suman's account. And what we will debit? She is giving the cash, so cash we will debit. Cash account or bank's account we will debit. Okay, so simply debit the receiver, who is receiving, bank is receiving, and credit the giver, who is giving, Suman is giving. In case of a real account, we have to debit what comes in, we have to credit what goes out. For example, if we purchased the furniture in cash, right? So what comes in? Furniture will come into the company. So furniture must be debited, and what goes out? Cash is going out. So cash must be credited. Okay, so in that way you have to remember. In case of a nominal account, expenses or losses we have to debit. For example, if we have purchased something, there is expenses for us, so we will debit the purchase account. Income or gain, if the sales has happened, we will credit the sales account. Okay, so it is very important. For exam point of view, you have to note that the sales, these are the sales are the credit. Always remember, sales are the credit. Okay, we have to credit it. And the expenses or the losses means what? Simply the purchases are the expenses or the losses. Okay, you remember. However, cash is the real account, which you have to remember. Cash is the real account, because maximum times we have to use the account cash. If the cash comes in, we have to debit. If cash goes out, we have to credit. Okay, it is the real account. Okay, so in case of a personal account, debit the receiver, credit the giver. In case of a real account, debit what comes in, credit what goes out. In case of a nominal account, expenses, losses debited, and sales, purchase, that is income gains credited. Okay, sales or the income gains we have to credit. Okay, I repeat, for nominal account, expenses or the losses we have to debit, income or the gain we have to credit. Okay, so it is very important that you have to mug up. You don't have any option. You have to mug up this chart, which is very important. Now see, in summary part, see, we have the type of accounts: real account, personal and the nominal. Real means what? Simply all the assets are the part of real account. Personal means all the parties are the part of personal account. And in case of a nominal, item of profit and loss are the part of nominal account. Okay, what is the rule in case of real account? Debit what comes in, credit what goes out. In case of the personal account, we can say the debit receiver, credit the giver. In case of the nominal account, debit expenses, credit gain. Okay, credit income and gain. Okay, these are the summary chart you have to note. Now see implication. What you imply if there is a debit in personal account? Personal account means like your own account, with salary account. You are having account in bank. So when there is debit, implies that the person whose account is debited has become the debtor of the business. What do you mean by credit in personal account? Credit in personal account implies that whose account is being credited is become the creditor of that business. What do you mean by it? See, for example, this person, the ABC is the business, right? ABC Enterprises, right? ABC Enterprises has purchased goods from on a credit from, say, supplier. Yes is the supplier. Okay, so supplier, once goods purchased, the supplier's account should be credited. Supplier's account should be credited. So supplier become the creditor, and the goods account or the company's account must be debited. So company become the debtor, right? Next. So it is very simple when you are using the CC in your bank, right? So the person who is giving the goods on a credit become the called as the creditors, and person from where you are getting the money, right? It is the debtor. You means simply the person from who is liable to pay you money. For example, you have given your friend 50,000 rupees. So your friend become a debtor and you become the creditor. Okay. debit in a real account, credit in real account. So in case of a debit in a real account means what? See, it implies that asset value has increased. See, when we debit the cash, debit what comes in, debit what comes in. For furniture purchased, we will debit the furniture. Means what? For asset has been increased. Credit in a real account implies that asset has decreased. So when there is a credit, for example, if you have credited the furniture, right, you have credited the furniture, means what? Asset had decreased, you have sold the furniture of your company. Okay, so when we learn the example, that time you will get better idea. Just you go through it. Okay, debit in nominal account. So when we debit in nominal account, so if there is losses or the expenses. When we credit in nominal account, when there is income or the profit, right? So very simple. When there is losses or expenses, we have to debit the nominal account. When there is income or the profit, we have to credit into the nominal account. Okay, or in the reverse fashion, I also say that if I see the expenses, it means there is a debit in nominal account. Okay, in a simple way, it is very simple, right? So see, asset has decreased means what? You sold the asset, so you have to credit the real account. Okay, asset has increased means you purchased the asset, so debit the real account. Okay, so it is very simple. When we solve the numerical, that is the passing of a journal entry, that time you will get better idea. Okay, now see, pass the journal entry. This type of example can be asked in the examination. Okay, so Mr. J purchased a computer worth 60,000 for cash. So what are the rules? First, we have to identify which are the accounts. So in the book of Mr. J, we are writing the entry in the perspective of Mr. J. So see, what are the accounts affected? First we have to identify. So computer, there is asset account, and second is the cash. These are the two accounts we have identified, right? So computer purchased in cash, so two accounts are there, computer and the cash. So computer what comes in, and therefore computer account is debited. Why? Because computer, see, computer is what? It is asset, so it is a real account, right? So what is a real account rule? So what comes in, we have to debit. What comes in, we have to debit. What goes out, we have to credit. Okay, so here computer purchased, so computer is coming in, so we have to debit the computer account. Cash is also the real account. What is the rule? What is goes out, we have to credit, so cash account must be credited. So I can say the computer account must be debited, so I will write computer debit by 60,000, right? And I will write the cash credit by 50,000. So this is the simple entry I have to do. Okay, so in that way you have to write the entries. Second example, Mr. A purchased the goods worth whatever from Mr. R. So see, in the book of Mr. A, goods come in, so goods account is a real account, therefore a goods account must be debited. So what is the rule in case of a real account? See, all assets purchased, goods, machinery, these are simply the asset, right? So in case of a goods account, that is the asset account, what comes in, we have to debit, right? So goods are coming in, so goods account we have to debit. So I will write here the goods debit. So next, what should be credited? Simply see, who is getting benefited? R is getting benefited, right? R gives benefit in the form of goods. R gives the benefit in the form of goods. So R is a personal account. Therefore, what is a rule for a personal account? Who gives the benefit, that must be credited, right? So R's account must be credited. So at least you should remember one account. If you are able to get one account, for example, goods debit, otherwise automatically R's account you have to credit, right? There must be the equivalent, right? Debit credit. Okay. Next is the Sheetal gives loan of 8,000 to Rita. So simply here are two parties are involved, right? What are the two accounts? Rita and the Sheetal. Now who is giver and the receiver? Sheetal is the giver who offered the loan. So Sheetal is giver. So who gives the cash? Who gives the benefit? That account must be credited. It is the rule of a personal account, right? So Sheetal is giver. So her account must be credited by 8,000. Rita is a receiver, right? Rita is a receiver, is receiving benefit. So her account must be debited. You can compare that with like a cashier, right? Cashier receives the cash, so cashier is the benefit. So cash account we are debiting, and respective cash we are crediting to the customer's account, right? So in that we also compare. Sharad sells goods to the Vilas for 5,000 on a credit. Now see what is happening here. What are the accounts involved? The Vilas's account and the Sharad's account. So Vilas account and the Sharad's account. Who is receiver? See, Sharad has sold the good. to the Vilas. So Vilas is receiving the goods. So Vilas is the receiver. Sharad is a seller. So Sharad is the giver. So we know in case of the personal account, Vilas is receiver. So debit the receiver, credit the giver. So the Vilas account we will debit and the giver Sharad's account we will credit. Okay. Sushma withdraw 10,000 from the Indian bank. It is very much common with you, right? So so Sushma has withdrawn the money. So who is giver? The Indian bank is giver. So Indian bank account we will credit the giver, and Sushma's account we will debit, right? Also we can write that right here, the cash account we can credit, right? How? Because we are giving the cash, we are the bank is giving, so debit what comes in, credit what goes out. In that way also you can remember. Okay, very simple. You should remember at least one entry. You should either identify at least credit or a debit. If you identify one, automatically other you can easily judge if one is a credit, other can be the debit. Jaswant purchased a furniture worth 5,000 for the cash. So which accounts are involved here? The furniture and the cash, right? So both the furniture and the cash, these are the real accounts. So what is a rule for the real account, right? What comes in, we have to debit. What comes in, we have to debit. And what goes out, we have to credit. So here furniture is coming in. So furniture we have to debit. What comes in, debit. What goes out, cash is going out. For cash we have purchased, we have given the cash, cash is going, so credit the what goes out. Okay, so furniture account debited, cash account credited. Next, Suresh received 5,000 from Ramesh. So see, Suresh received 5,000 from Ramesh. So which accounts are involved here? So we have to assume that the transaction happen in cash, unless it is mentioned that the transaction happen into the in credit. Okay, so we assume it is a cash transaction happening in cash. So what we can do, see, Suresh has given Ramesh for cash. So cash is either in the book of Suresh we have the two accounts. One is the cash account will be there, another is Ramesh. So when cash goes out, it is the real account. So we have to credit what goes out, and obviously Ramesh account we should debit, right? So therefore cash account is debited. See, what comes in, what is happening, Suresh is receiving the cash, Suresh is receiving the cash, right? So cash is coming to the Suresh. So what comes in, we should debit in case of a cash, that is a real account. What goes out, that must be credited, right? So very simple, right? I repeat, see, Suresh is received 5,000 from Ramesh. So Suresh has received from Ramesh the cash, right? So in the book of Suresh we can say cash account is, cash is what, received. So when cash is received, that must be debited because it is a real account. Debit what comes in. Obviously the Ramesh account we will credit simultaneously, right? Why? Because see, Ramesh is a personal account, right? And in case of Ramesh is a giver. In case of the personal account, credit the giver. Next, the trader pays 1,500 to the manager as a salary. So here what is happening, we have to assume that the transaction happen in cash, okay, unless it is mentioned. So cash is going out. When the cash goes out in the book of trader, cash is a real account, right? That's why when the cash goes out in case of real account, what goes on, we will credit. What comes in, we will debit. So cash going out, we will credit the cash, right? Salary is an expense. It is a nominal account. So salary is debited. In case of nominal account, very simple. Whenever expenses are there, obviously we have to debit. Very simple, right? Next, Ramniklal pays rent of 500 to the property owner Rasiklal, right? Now see, we have to assume that the transaction happen in cash unless it is mentioned. It is a credit transaction. Okay. Ramniklal is paying 500 to the Rasiklal. So in the book of Ramniklal, cash is account which cash goes out. Cash is a real account. So in case of real account, we will credit what goes out, right? So cash account must be credited, right? So we will write the cash account credit, and one account must be debit, what? The rent account. Why? Because rent is a nominal account where we are paying, right? So it is expenses that must be debited. Very simple. In the book of property owner Rasiklal, so this is what the point of view of Ramniklal. Okay, in the book of Rasiklal. So at the point of view of Rasiklal, what we will have to think, see, Rasiklal is now receiver of 500, right? So for Rasiklal, cash is coming in. because he is receiving the cash. Cash is a real account. So what is the rule for the real account? Debit what comes in. So cash we will debit in the book of Rasikalal, right? And rent is income, so we will credit the rent in the book of Rasikalal, right? So whatever income, profit, that must be credited. Whatever losses, that must be debited. Okay, so that you have to think. Okay, very simple. Now see, ABC company sold 10,000 worth of material on a cash. Now see, the two accounts are here involved, right? One is the cash account and another account is the company's account, ABC company account, or you can say a sales account. Simply remember, whenever sales happen, you directly credit it, and other account you debit it. So sales always credited, other account always debited. One is credit, obviously other will be debit. Very simple. For the simple funda you remember, sales account always credit and purchase account always debit. Okay. Next, ABC purchased 20,000 goods on credit. Now there are two accounts are involved, right? One is the we are purchasing, right? So in the book of ABC, we are purchasing. So one is purchaser account, another is we are purchasing on a credit. So there must be the creditor or the supplier. We can say supplier or the creditor. Okay. So two accounts are involved. So the purchase account is always debited, always debited. So obviously other account you have to credit, right? In that way also you can shortly, you can easily remember. Identify at least one, other you will judge. ABC company did a payment of rent by check. So see what account are involved here. The rent account is involved, very simple, right? And payment made by the check. So bank account can be involved here. So in case of rent account, what is happening? See, we are paying, the company is paying, so it is expenses. So we have to debit the rent. So one is debit, other must be the credit, right? So purchase the goods 50% on payment made by the check. So here three transactions are involved. It is also called as the combined entry. It is also called as the combined entry. Now see which are accounts involved. See 50% made payment by check. So obviously you can easily judge 50% must be made by cash, right? So what accounts are involved? Goods purchased 50% payment made by check. So purchase account, there must be the purchase account, right? There must be the 50% only payment has been done. So the by check, so bank must be involved and the creditors or the suppliers are involved. So when there is a purchase, must debit, right? And when the creditors, when we receive something from on a credit, so creditors account always a creditor, always remember, because name it is indicating supplier or the creditors account always credited in the book of company's account. Okay, so debit and bank account must be debited. So what is happening here? Why we are debiting the, why we are creating the bank's account? Why you are creating? Simply because bank is doing the payment, right? So bank account has to be creditor, credit the giver. Okay. Now goods are sold, 50% payment received in cash from Soham. Now here we are selling, the company, as a company we are selling, right? So what accounts we can involve here? So the 50% payment received in cash from Soham. Now see, the cash account will be there, right? In cash we have received a 50% payment. So always remember, when they mention 50% payment made by check, so we are introducing the bank here. They are mentioning 20% payment in a cash, so we are taking the cash account here. Okay, in that way you have to remember. So the cash account will be there, right? Then the Soham account will be there, right? And then we are doing the sales, so sales account must be there. Okay, whenever there is a sale, we always credit. Very simple thing. Say 50% cash we are receiving, so cash is a real account. What is the rule? The rule is what comes in your debit, so debit the cash. Okay, now what about Soham? Soham is the giver of the cash. Soham is the giver, right? So we are 50% payment received in cash from Soham, right? So Soham is the 50% payment we have received. Still 50% is pending with Soham. So Soham is the debtor, right? So we will debit the Soham's account. Okay, so in that way you have to mark the combined entry. Okay, so friends, we will stop here. In the next session we will learn about the cash book and the remaining portion. Okay, so meanwhile you can do one thing. You can subscribe us on the YouTube Banker Zone. You can join our Telegram channel. You can download the application available at the Play Store, Banker Zone JAIIB. This is the contact number. which is available on WhatsApp. You can ask any query if you are having using the WhatsApp. So thank you friends. Don't forget to subscribe Banker Zone.